If I were to restart with my first $10,000, this is how I would spend my money in 6 types of investments. In your 20s to early 30s, time is your best friend. The earlier you start investing, the easier it becomes to grow your money and build wealth, even if you're just starting with a little bit. This is because you have more time and energy to recover from a potential loss, so you can afford higher risk, high reward investments. In other words, the earlier you start investing, naturally, the more willing you are to prioritize growth over stability. When you invest, you're putting your money to work instead of working forever for money. But I totally get why many people struggle to take action. I'm only 26, so I still believe that I have a lot more to learn, but I can share with you how I picked my investments since 19 years old, which contributed to my first rental property at 23 years old, and a 6-figure investment portfolio that generates thousands of dollars of passive income for me. Investing can feel intimidating, especially if you've never done it before. You're probably seeing different videos recommending stocks, ETFs, REITs, and crypto and wondering, where exactly should I put my money first? With little money to start, your investing goal should be clear and straightforward. You want to prioritize growth while still maintaining some diversification for stability. Let's hit the like button and build a $10,000 portfolio together. Step 1. Invest 30% of your money in stocks. I would put my first $3,000 in stocks. That's about 30% of $10,000, and I'm referring to individual stocks, which means investing in specific companies. Because historically, stocks have provided higher returns compared to other assets over the long term. At the same time, you should know that stocks come with higher risks and therefore higher rewards. They do have ups and downs, that's why it is important to start investing early to have time on your side to ride out the volatility. First, blue chip stocks. These are large, reliable companies that have been around forever. Companies like Apple, Microsoft, Coca-Cola, or Amazon. They're stable, safe, and usually pay dividends too. Second, dividend stocks. These are companies that pay you cash regularly just for holding their stock. My personal favorites are Canadian dividend payers like TD Bank or Enbridge. And third, growth stocks. These are higher risk, but can potentially give you bigger gains. Companies in tech or innovation like Tesla or Apple are good examples. You don't need a lot. If you follow me on Blossom, which is a social media for investors, you can see exactly what stocks I'm holding now. I like to focus on gaining more equity on a few core stocks that I have researched well, rather than finding the best performing stocks over and over again. Because I can use the ETFs to get myself some exposure in all the other stocks that I do not own directly, which is what I'll be explaining next. So to wrap up for stocks, at the bare minimum, your core stock should meet at least one of these criteria. 1. The stock consistently pays well in dividends over the years. Or 2. The stock has been long-term bullish or has proven to bounce back from recessions. Let's move on to my favorite type of investments, the ETFs. Step 2. Invest 30 to 40% in ETFs. I put the next $3,000 to $4,000 or about 30 to 40% of my total investments in ETFs. If you're brand new to ETFs, these are just a group of stocks combined into one simple investment. Think of it like buying a basket of many different stocks all at once. This helps diversify your money instantly so you don't rely heavily on a single company's performance. My absolute favorite ETF is VFV, which is a Canadian ETF that tracks the S&P 500, known as the best 500 companies in the US. The best thing is that I can pay in Canadian dollars to buy VFV without worrying about currency conversion rates. That means you can save more money while getting the same growth rate as the S&P 500 of the US stock market. You guys know the US dollar is becoming more and more expensive for us Canadians, so make sure you follow and subscribe to your Canadian finance girly here, because you can always count on me for the best money saving and investing tips. By buying VFV, I'm instantly invested in Apple, Amazon, Nvidia, Tesla, and all other top 500 companies in the US, all in just one ETF. Another ETF that I really like is VDY, which focuses on high dividend Canadian stocks. This ETF regularly pays dividends, providing cash flow without lifting a finger. I always say to reinvest those dividends back into your portfolio to make sure your investments grow even faster. ETFs give me peace of mind because they're diversified. This means I don't have to spend hours researching every individual company. It's the simplest way to invest if you're just starting out. If you're like me and you just want to make your life easier, comment ETF below and I'll share a link to a free tutorial about my top 3 ETFs and how I analyze them. So that's it for ETFs. Remember, ETFs help us with diversification and reduce the need to micromanage your portfolio. Next, let's look at another way to diversify your investment portfolio, which is real estate, but without buying actual properties. Step 3, invest 10 to 15% in REITs, With the next $1,000 to $1,500, I put my money into REITs. REIT stands for Real Estate Investment Trust. This basically allows you to invest in real estate without needing to own property yourself. It's like becoming a landlord, except you never have to deal with tenants, repairs, or property taxes. When you invest in REITs, you're buying shares of companies that own income-producing real estate. This could be apartment buildings, shopping malls, office spaces, or even industrial warehouses. The reason I personally like REITs is because they pay you monthly dividends from the rental income they generate. It feels like getting paid rent without having to do anything that a landlord has to do. So this is another form of consistent passive income that grows over time. One of my favorite REITs is RioCan, a Canadian REIT focused on retail spaces and properties. Another one is Canadian Apartment Properties, known as CAPREIT, which invests in apartment buildings across Canada. Both have solid track records of reliable dividend payouts. REITs also help diversify your portfolio since real estate doesn't always move in the same direction as the stock market. If stocks are down, real estate could be stable or growing. If you're looking to invest in real estate but don't want the headaches of managing physical properties, REITs are perfect. They're simple, they pay dividends, and they help keep your portfolio balanced. Also, you don't have to go through the hassle of selling an actual property, like putting up for sale, showings, or real estate fees, etc. Now that we've covered stocks, ETFs, and real estate through REITs, let's talk about keeping some cash readily available in case life throws you a curveball. Step 4, keep 5 to 10% in a cash ETF for flexibility. I put the next $500 to $1,000 into a cash ETF instead of a regular savings account because it keeps your money accessible while still earning a return, perfect for when a great investment opportunity comes up. Now, I know holding cash might not sound as exciting as stocks or real estate, but it serves as an important purpose. It acts as a financial cushion, giving you liquidity without having to sell investments at a bad time. Maybe the market dips and you want to buy in, or an unexpected expense pops up. This money gives you options. Unlike a regular savings account, cash ETFs typically offer competitive yields while still keeping your funds liquid. Again, if you follow me on Blossom, you'll see that I hold the cash ETF. Step 5, invest 5 to 10% in GICs, guaranteed investment certificates. I'd put another $500 to $1,000 into GICs, which stands for Guaranteed Investment Certificates. If you're new to GICs, they're the safest investments because they are literally guaranteed. You give your money to the bank for a fixed period, like 6 months, a year, or even up to 5 years, and they pay you a guaranteed interest rate. The main benefit is safety. Your original investment is guaranteed, plus you know exactly how much interest you'll get. There's no guessing or worrying about market volatility. I recommend something called laddering your GICs. This means splitting your money into smaller amounts with different maturity dates. For an example, you can put $250 into a 1-year GIC, another $250 into a 2-year GIC, and so on. This way, some of your money becomes available each year, which gives you flexibility in case you need your money sooner, and if interest rates go up, you can reinvest at a higher rate. GICs are a perfect option if you prefer low risk, or actually it's risk-free. You just want to make sure a portion of your money stays completely safe and predictable. Now let's move on to the last piece, my take on crypto investing. Step 6, invest 5 to 10% in crypto. Finally, I put the remaining $500 to $1,000 into crypto. Crypto is definitely the most exciting, but also the riskiest part of my portfolio. Personally, I treat crypto like a high-risk, high-reward opportunity. So I never invest more money than I can comfortably afford to lose. For beginners, I'd suggest sticking to the major cryptos first, like Bitcoin or Ethereum. These two are considered the safest choices in the crypto world, even though they're still volatile. I also recommend using a trusted exchange like Coinsquare because it's regulated and beginner-friendly. That way you won't have to worry about security or complicated setups. Remember, crypto is a long-term play. Prices go up and down a lot, but holding on long-term has historically rewarded investors. For me personally, I sold all of my Bitcoin last year when it hit $100,000 Canadian. But if I were to jump back into crypto today, it would be a very, very small portion of my portfolio. Or you can look at FEQT. This ETF invests partly in crypto-related companies, giving you exposure to crypto without the direct risk and tax implications of owning crypto itself. Plus, it makes your taxes way simpler because you can hold it in your TFSA or RRSP for tax advantages. So that's how I'd invest my first $10,000. We've covered individual stocks, ETFs, REITs, cash ETFs, and GICs in crypto, creating a diversified portfolio designed for both growth and stability. Let's quickly go over everything again. First, I put 30% into individual stocks, choosing solid companies that either grow consistently or pay reliable dividends. Second, 30 to 40% would go into ETFs like VIV and VDY. These help diversify your portfolio effortlessly and save on currency conversion fees. Third, around 10 to 15% would be invested in REITs, allowing you to benefit from real estate income without actually buying property. And fourth, I'd keep about 5 to 10% in a high interest cash ETF for quick access and maybe financial opportunities. Fifth, another 5 to 10% would go into GICs for safe, guaranteed returns. And finally, about 5 to 10% in crypto using CoinSquare for Bitcoin or Ethereum, or looking into FEQT. The key to investing your first $10,000 is simply getting started. Please don't worry about timing the market perfectly. Think about how much time you can stay invested in the market. If you're serious about taking action now, comment to let me know how you would invest your first $10,000. Would you do anything differently? I'd love to hear your ideas. And if you enjoyed this video, make sure to like and subscribe. Also, check out this video over here to see my latest investment portfolio update. See you in the next video.